have to wonder, the headlines keep getting worse and worse, and the markets keep ignoring it. Why? And are you ignoring it?
Well, it's very typical. I always talk about the wall of worry that the markets have to overcome. And we've seen that since March. I mean, we've seen this market keep on going up and up. And you pick up the newspaper or you turn on TV, and it's more about deaths from COVID-19. So it's very typical that this kind of thing happens. Of course, the news has to tell you what is going to harm you, so it tends to be more negative. But the people really are looking to a V-shaped recovery, and I think you're seeing that around the world. The recovery in emerging markets has been incredible, and of course the U.S. has led the whole bunch and has done very, very well.
Mark Mobius, what's actually moving emerging markets more? Is it COVID-19, the number of deaths and infected, or is it the Fed and yields in the U.S.?
I think it's a combination of a few things. First, of course, the Fed. The fact that the interest rates have gone down, that means these emerging markets rates for their sovereign debt and their corporate debt can also move down. That's one thing. The second thing is the amount of money that the World Bank, the IMF, and all these other organizations are putting into these markets to enable them to pay back their debts and do some infrastructure spending. So that's another thing. And, of course, within the countries themselves, they've been increasing spending, taking a lot of their budget. Of course, that means the budget deficit is going to be greater, but that's also been pouring into the markets. So I think it's a combination of these things that have led to an increase. And the interesting thing is that gold has done just as well as the equity markets. I noticed that although gold lagged since the beginning in March this year to now, gold has lagged the S&P 500. But if you look at the 5-year numbers, it's exactly the same. Both have gone up about the same from that about 75% from the low in 5 years. So we're in a very interesting situation where people are looking at stocks to preserve their capital because stocks will adjust to inflation, and also gold. So they're sort of hedging their bets.
Well, I'm glad you brought that up because, when I look at real yields, particularly in the U.S., and then I look at gold, that to me doesn't really say V-shape. And it seems like, in terms of inflation expectations, we're still like 100 basis points off even where we were like a few years ago. So how do you reconcile that?
Well, I think one thing you have to remember that when interest rates are high, people will tell you, oh, you're holding gold. Gold does not pay any interest. But when interest rates are zero or near zero, then gold is an attractive medium to have because you don't have to worry about not getting interest on your gold. And you see the gold price will rise as uncertainty in the markets are rising. By the way, one of the other interesting things about gold, and I haven't looked at the numbers recently, is what the supply coming out of the mines is going to be. With this COVID, I assume that mine output should be declining for gold, and that, of course, puts additional pressure upwards on the price.
Mark, when you look at the U.S.-China, the latest U.S.-China spat, does that diminish significantly your appetite for Chinese assets? I mean, should we assume that we're going to see many more fights between China and U.S., China and U.K., China and Europe, and other countries or regions?
Well, we've factored that in to our calculations. And China is, of course, very important in our funds. It's along with Brazil, China and India are very big for us. So we look at Chinese companies in a separate light. In other words, we look at what their global non-U.S. activity is. So, for example, I don't know whether you've seen it, that Alibaba Financial Services has now teamed up with Vodacom in South Africa to provide financial software and apps. So this is the kind of thing that's happening. In other words, these Chinese companies are moving globally to places where they're not going to be affected by the situation in the U.S. So that's where we have to look.
All right, we'll get to that in 2 seconds, more specifically what you're looking at. But just before we get there, gold, are you buying it at these levels?
Oh, yes, I would be buying now and continue to buy because gold is really
silver?
on a run, I think. doing well.
What about silver?
Silver also, because silver, of course, will follow gold. But gold is, of course, the most important.
When you look, Mark, I remember you talking quite a lot about the frontier markets, and I don't know whether, COVID changes your appetite for frontier markets, because in terms of health systems, they're even, more maybe difficult to cure people than in emerging markets.
Yeah, that's true for some of these markets, but it's interesting to see how in many of these frontier and emerging markets, the government's lockdown has even been more severe than what you've seen in some of the developed markets. I was in South Africa, locked down for a month in Durban. I couldn't even go out in the streets. So they were very, very strict. That was 2 months ago. And Kenya would be another example. We have an investment in Kenya, and they've done a pretty good job in, trying to stop the spread. So I'm not too worried. Of course, there are some markets that just don't have the money and the capability to do any effective lockdown, but it's a spotty scenario. Some are very good, some are not so good.